Frasers Centrepoint Trust FCT, Singapore's leading suburban retail RIT with malls like Causeway Point and Northpoint City, is a key player in shaping daily community life. But with the Singapore, Johor RTS link set to open in December 2026, questions loom over whether cross-border convenience will draw shoppers away to Johor. In this video, we'll break down FCT's financial performance, portfolio resilience, valuation, and analyst sentiment, while examining both the risks of spending leakage and the opportunities from northern catchment growth and Woodland's rising importance. To help you decide if FCT remains a stable, income-generating REIT for your portfolio. Frasers Centrepoint Trust FCT is Singapore's largest suburban retail RIT, backed by sponsor Frasers Property, with about 8.3 billion Singapore dollars in assets under management as of June 2025. Its portfolio includes 9 suburban malls, such as Causeway Point, Northpoint City, and NEX 50% interest, plus Central Plaza, offering over 3 million square feet of retail space anchored by necessities, spending, F&B, and essential services. FCT reported near full occupancy at 99.9% and strong rental reversion in 1H FY 2025, underscoring income stability. Growth is driven by organic improvements, asset enhancement initiatives, and acquisitions like Northpoint City South Wing. Listed on SGX since 2006 and part of major indices, including the Straits Times Index and FTSE SDRT Index, FCT remains a resilient income play with deep roots in Singapore's suburban communities. Frasers Centrepoint Trust, or FCT, is Singapore's largest suburban retail RIT, and its portfolio breakdown tells a clear story. Looking at the first pie chart, we see how gross revenue is spread across its properties. Causeway Point is the single largest contributor at about 93 million Singapore dollars, followed by Northpoint City North Wing at 57 million Singapore dollars, and joint venture malls like NEX and Waterway Point, each bringing in over 40 million Singapore dollars. Other suburban assets like Tyon Baru Plaza, Century Square, White Sands, and Hoging Mall add depth and diversification, while Central Plaza, the only office building in the portfolio, contributes a modest 10 million Singapore dollars. Together, these 9 malls and 1 office property generate a steady income base, anchored in Singapore's heartland communities. Now, shifting to the second pie chart, the rental contribution by trade category. Here, food and beverage dominates at about 115 million Singapore dollars, or nearly 40% of total rental income, showing how FCT's malls are built around daily essentials and dining. Beauty and healthcare contributes 43 million Singapore dollars, while fashion and accessories adds 41 million Singapore dollars. Supermarkets, electrical and electronics, leisure and entertainment, and other service-based tenants round out the mix. In total, FCT manages over 1,900 leases across 3 million square feet of space, serving a combined catchment of around 3 million people. What stands out is the resilience of the suburban strategy. By focusing on essential, high-frequency spending categories and well-located malls near MRT stations, FCT secures stable footfall and rental streams. And while retail makes up about 97% portfolio value, the inclusion of Central Plaza ensures a small, steady office income component. Together, these charts highlight how FCT balances income across both properties and tenant types, making it one of Singapore's most community-anchored and resilient REITs. Frasers Centrepoint Trust reported revenue of $908.8 million TTM, though FY 2024 revenue of $351.7 million dipped 5% from 2023. Net income held steady at $588.8 million, slightly higher than last year, while EBITDA surged 18% to $802 million, showing strong operating performance. Margins remain healthy, operating margin around 64%, down from 71.9%, and net profit margin at 64.8%, an improvement over 2024. Free cash flow eased to $611.8 million, weaker than 2024's $725 million. On the balance sheet, leverage stayed stable at 0.63 debt to equity, down from 0.70 in 2023. Earnings per unit held flat at 11 cents, with average daily trading volume of 8.6 million units. Overall, FCT continues to deliver stable earnings, high margins, and controlled leverage despite softer revenue and cash flow. Let's take a closer look at Frasers Centrepoint Trust's financial performance from 2021 to 2024. Starting with gross revenue, FCT recorded steady growth from $341 million in 2021 to a peak of $369.7 million in 2023. However, revenue dipped 4.9% in 2024 to $351.7 million, mainly due to the divestment of Changi City Point and asset enhancement works at Tampines 1. The same trend is seen in net property income, which rose from $246.6 million in 2021 to $265.6 million in 2023, before easing slightly to $253.4 million in 2024. Even with this dip, operating efficiency remains strong, with NPI margins holding at around 72%, showing disciplined cost management. On distributions, DPU has been remarkably stable, hovering around 12 cents per unit each year, with 2024 coming in at 12.042 cents. This stability highlights the Trust's commitment to consistent payouts despite income fluctuations. The payout ratio has also stayed steady in the low 80% range, which is typical for Singapore REITs and ensures unitholders continue to enjoy attractive income visibility. Overall, FCT's numbers reflect a resilient suburban retail REIT, delivering stable margins and consistent distributions, even as revenue softened slightly in 2024 due to portfolio adjustments. Frasers Centrepoint Trust valuation has stayed stable over the past 4 years. Its NAV per unit held around $2.30, while the PB ratio moved from a slight premium in 2021 to near book value in 2024. Dividend yields have consistently ranged between 5.2 and 5.6%, reflecting steady payouts. Overall, FCT continues to trade close to fair value, offering investors both income stability and resilience. Frasers Centrepoint Trust funds from operations grew steadily from about $866 million in 2021 to a peak of $932 million in 2023, before dipping to $692 million in 2024, mainly from higher financing costs and asset divestments. At the same time, the interest coverage ratio compressed, falling from over 5 times in 2022 to around 3.4 times in 2024. While margins are tighter, FCT still maintains a safe buffer above regulatory requirements, reflecting resilient cash flow despite rising debt costs. Frasers Centrepoint Trust capital structure has remained disciplined over the past 4 years. Gearing rose from about 33% in 2021 to just under 40% in 2024, still well below the regulatory cap of 50%. This shows the Trust has room to take on debt if needed, while keeping leverage at a prudent level. The cost of debt has climbed steadily in line with global interest rate hikes, moving from just 2.3% in 2021 to around 4.1% by 2024. Even so, FCT has managed this risk through active hedging. Around 2/3 to 3/4 of borrowings are fixed, meaning the majority of interest expense is shielded from further rate increases. Finally, the debt maturity profile has improved. The average tenor now stands at 2.6 years, with only 13 to 15% due in 2025 and 2026, and the rest spread out longer term. Overall, FCT's debt management reflects a cautious but resilient approach, balancing growth with financial stability in a higher rate environment. Frasers Centrepoint Trust maintains a well-diversified debt profile. As of June 2025, total borrowings stand at $2.86 billion. The composition is primarily unsecured bank borrowings at 58%, followed by secured borrowings at 39%, and a small portion in medium-term notes at 2.7%. This structure provides flexibility while limiting refinancing risks. Looking at the debt maturity schedule, the largest repayment cluster is in FI 2029, with about $1.22 billion, or nearly 43% of total borrowings, falling due. Ahead of that, maturities are more evenly spread, $459 million in FI 2026, $133 million in FI 2027, and $224 million in FI 2028. After FI 2029, another $739 million comes due in FI 2030, while the tail end includes just $80 million in FI 2032. Overall, the maturity profile shows that while FCD faces a sizable refinancing in FI 2029, the rest of its obligations are well staggered, ensuring manageable refinancing risks and stable funding visibility. As of June 2025, Frasers Centrepoint Trust tenant base is highly diversified. The top contributor, NTUC Fair Price, accounts for just 5.9% of gross rental income, followed by Bread Talk Group at 3.1% and Dairy Farm at 1.7%. Other major names like Quartz, Metro, Uniqlo, and OCBC each contribute around 1 to 1.3%. In total, the top 10 tenants make up only 18.6% of rental income and 22.7% of net lettable area, showing that no single tenant dominates the portfolio. This broad spread enhances income stability and reduces concentration risk. In FY25, only a small portion of Frasers Centrepoint Trust leases are due for renewal, reflecting a low lease expiry risk. Across the retail portfolio, 54 leases covering about 47,400 square meters will expire, representing just 1.7% of total leased area and 2.3% of gross rental income. Among the malls, the largest exposures are at Tyon Baru Plaza with 5.8% of GRI, followed by Century Square at 3.4% and NEX at 3.2%. Other assets like Causeway Point and White Sands have minimal expiries below 1% of GRI. Separately, Central Plaza, the only office asset, has one lease expiry accounting for 4.9% of its GRI. Overall, the figures show that FCT's FY25 lease rollover risk is very manageable, with expiries well spread across properties and no heavy concentration in any single mall. Frasers Centrepoint Trust lease expiry profile is well spread out, with no concentration risk in FY25. Only 2.3% of gross rental income is due for renewal in FY25. The bulk of expiries come in the following years, about 28% in FY26, 32% in FY27, and 30% in FY28. Beyond that, just 5.9% falls in FY29 and a minimal 1.4% after FY30. This staggered lease maturity ensures that rental income remains stable and resilient, with expiry spread evenly across multiple years instead of clustering in a single period. Frasers Centrepoint Trust maintain an exceptionally high committed occupancy of 99.9% across its retail portfolio as of June 2025. Most malls, including Northpoint City, Causeway Point, Waterway Point, Century Square, and White Sands, achieved a full 100% occupancy. Others like Tampines 1 and Tyon Baru Plaza saw slight improvements, while NEX remained stable at 99.9%. The only non-retail property, Central Plaza Office, held steady at 97.5%. This near-full occupancy across all major assets highlights the resilience and stability of FCT's suburban retail portfolio. Singapore's suburban retail market shows a positive outlook ahead. First, looking at the future supply pipeline, new retail space remains limited, especially in Orchard and the suburbs. This restricted supply helps support occupancy and rental growth. Second, the occupancy rate remains strong, with Orchard Road above 95% and suburban malls maintaining healthy levels above 93% through 2025. Finally, the private prime retail rents chart shows steady recovery. Orchard Road rents are projected to rise to about $38 per square foot per month, suburban rents to over $32, and island-wide to around $27.50 by 2025. Together, these trends point to limited new supply, strong demand, and continued rental growth in Singapore's suburban retail sector. The Singapore-Johor RTS link, scheduled to open by end 2026, will connect Woodlands North to Johor Bahru in just 5 minutes, carrying up to 10,000 passengers per hour in each direction. This improved connectivity could shift some retail spending across the border. Estimates suggest about 5.4% in retail value leakage, translating to a 3 to 4% dip in Singapore retail sales, mainly in food, beverage, and services, where price differences can reach 30 to 50%. Now, looking at the chart, the orange bars show the projected retail impact, while the blue line highlights FCT's North Cluster exposure. Together, Causeway Point and Northpoint City North and South make up around 40% of FCT's rental income, meaning these malls are the most exposed to the RTS effect. But here's the cushion. These malls are necessity-driven suburban hubs, anchored by supermarkets and daily needs tenants. In fact, Causeway Point and Northpoint City have posted 7 to 8% annual sales growth in recent years, with occupancy near 100%. So while the RTS may cause some leakage in discretionary spending, FCT's essential retail mix, resilient anchors, and strong catchment suggest the overall impact will be manageable, not disruptive. Analysts remain constructive on Frasers Centrepoint Trust. Recent targets cluster between 2 Singapore dollars and 44 cents and 3 Singapore dollars and 7 cents, led by DBS at 2 Singapore dollars and 75 cents and UOBK Hainan at 3 Singapore dollars and 7 cents. The street average sits around 2 Singapore dollars and 65 cents versus a spot price near 2 Singapore dollars and 33 cents, implying low teens upside. Maybank, OCBC, and RHB all carried by calls after recent upgrades, while Phillip is accumulate. Independent trackers like Market Screener and TipRank show similar consensus near $2.54, 2.55, reinforcing a broadly positive outlook for FCT. Frasers Centrepoint Trust is positioned for steady, necessity-led growth. On the upside, the Johor, Singapore RTS from 2026 should deepen the North's catchment and could lift footfall at Causeway Point and Northpoint City. Completed upgrades at Tampines 1 and the ongoing Hogang Mall AI add near-term rental catalysts, while occupancy remains near full and rents are firming. Management continues to recycle capital from non-core assets and benefits from improving funding costs with most debt fixed. On risks, analysts see some cross-border spend leakage after the RTS, mainly in discretionary F&B and services. Funding costs, while easing, are still elevated versus pre-2022. FCT's short retail whale means frequent renewals, and new supply in a few nodes may temper reversions. Finally, as a Singapore-only portfolio operating under MAS 50% leverage ceiling, the trust is more exposed to domestic cycles and has finite balance sheet room. Net-net, catalysts are tangible, but execution on AEIs and maintaining pricing power through the RTS transition will be key. And that wraps up our deep dive into Frasers Centrepoint Trust. Despite near-term risks from rising rates and the upcoming RTS link, FCT's resilient suburban mall portfolio, strong anchors, and asset enhancement projects keep it well-positioned for steady income. What do you think? Will the RTS be a risk or an opportunity for FCT? Drop your thoughts in the comments below. And if you found this breakdown useful, don't forget to like, subscribe, and hit the notification bell so you won't miss our next RIT analysis.